So let's talk about debt. Now, what is the true cost of debt? Well, the true cost of debt is interest. And what increases the cost of debt is a longer payback period. So this is pretty much the risk of how much money is at stake for a certain amount of time. And what also increases the cost of debt is the borrower's likelihood of paying back. So you're going to pay back in full or in part, because depending on this situation that you're in, it will actually raise your cost of debt being interest. So it could either be 14%, it could be 19%, or even 23%. This is what the cost of debt is, it's interest. So let's talk about what debt can affect and what it will cost. So debt is known as one of the many things to consume a budget. And what I mean by this is that debt may offer a temporary increase in your purchasing power, but by doing this, your future earnings are actually spread thinner. Now, this is because you need part of those future earnings to pay off your debt. Chances are, if you're doing this to have a little increase in your purchasing power, you can't pay your debt off all at once. So it's going to drag out through month. And as it drags on, you will still have to pay your interest on top of what you already owe. Now, with you having to keep on spending a little more every month, this is known as credit creep. So it'll keep on consuming a bigger part of your expenses till at one point you find yourself overwhelmed with debt. Now, a way to do this or solve this problem is always by paying your debt off as fast as you can. But if that's not the case, then what do? Well, that's where it becomes a problem. That's where you need to look at your budget and figure out, what can I change to pay off my debt faster? So let's talk about unexpected events, because debt has an unexpected life cycle. And what I mean by this is that no matter who you are, where you are, and how old you are, debt can affect you in any way. And what I mean by this is especially in unpredictable events such as the loss of a job, you get sick and you can't work, or even now during this pandemic where people lost their jobs, people can't work because of this virus, you suddenly find yourself with a cut income or no income at all, but you still have to pay off your debt, right? Because you probably have debt from a couple of months ago, or you have student debt, or you just have debt from using your credit card. Now, the problem is without an emergency fund, which can supplement you for paying off this debt, you find yourself very restricted and you don't know what to do. This is also what leads to people to file for bankruptcy, because when you can't pay your expenses and you have zero income or suddenly find it becoming very limited, people tend to file for bankruptcy because they cannot stop their creditors from pursuing them, or from banks starting to close their houses down, take their homes from them, or even their cars getting repoed. Now, I'm not trying to scare you with this. The point of me saying this is that I want you to understand this is what debt can do. If you know how to go wisely with debt, or use your debt wisely, you'll be fine. But my point here is to say, hey, this is what can happen. Just know about it so it doesn't happen. Speaking about emergency accounts and savings, debt is also a pretty big obstacle when it comes to saving. And what I mean by this is that having access to relatively affordable and cheap debt gives people very few reasons or incentives to save for a rainy day, which pretty much means that it makes it that, why do you need to put money aside to save when you can just take up these small amounts of debt here and there, which cost very little compared to what other debts are? Well, this is a problem because, as I said before, what happens when something unexpected happens? Well, you gotta pay it off. And without any savings, good luck. Maybe from the bottom of my heart, good luck, right? So a great way to go around this is by creating a friendly cash flow budget. And what this does is that it takes a majority of your income and puts the bigger portion of it towards paying off your debt and your bills, while also taking a small portion of what's remaining and putting it into your savings account or into a saving area. Another reason that you shouldn't ignore your savings is, depending on how much debt you have, your credit score might not be too good either. And when buying something or putting a lease on something, or even getting any loan in general, having this extra saved money as a down payment or a bigger down payment will actually help you. And this is because having a bigger down payment will make it that you are borrowing less money. And when you borrow less money, you have less money to pay interest on, meaning your interest payments will actually be significantly smaller. So just know, when it comes to debt, no matter what debt you take, always make sure you save your money, because you never know when you'll need it the most. So let's talk about freedom of choice. As you might have guessed, debt can limit your freedom of choice. So no matter if your debt is good or bad debt, such as a mortgage on your house for your family, or you probably bought something way too expensive and you had to take a loan out, bad debt, you will always feel pinched when it comes to money. That's a big side effect of debt, whether it's good or bad. And this can, wear down on your mental state, right? Now, let's bring back unexpected life events into this picture again. So you already feel somewhat restricted with your freedom because you have a decent amount of debt, good or bad, as I mentioned before. But let's say something bad happens. So let's say you lost your job, you get sick, a family member gets sick, and you have to take care of them, or a loved one even dies. Prepare for the worst, right? What do you do with this debt you have now? Again, good or bad, debt is debt. You still owe money to someone, a bank, or an institution. Now, this is where it becomes a little tricky because you suddenly don't really know what to do. Unless you have an emergency fund, again, I will speak about this in another video, what do you do then? Well, there's a good chance that this lack of freedom can lead to some pretty bad decisions. And again, I'm just telling you this so you know. Let's say your debt is taking up 20 to 25% of your income every month, right? You always focus on paying this off because you don't want it to grow even more, right? You want to have a steady payment every month towards your debt. Well, what happens when your so beloved car has an expensive service? And it's either you pay the service off, but it's almost worth more if you just get a new car. What do? Well, you need to focus on getting your debt payments in every month before you even think about the service or the car, the new car for that matter. But you still need to get this done. So what are you gonna do? Well, as I said before, you're still gonna pay off your monthly debt, but you're going to go elsewhere to seek for a new loan for your service or for this new car. Chances are you will go to a high-risk borrower because they just want the higher interest rates, and that's what high-risk borrowers do, or high-risk lenders, my bad. They will lend you money, but in return, your interest rates will be higher. You will be forced into this, I don't know what I'm doing, I just need a loan. They will give me a loan. That's just a bad financial decision, and that is what a lack of freedom can do with debt. You find yourself pinched, you don't know what to do, you look for options, but your options with this lack of freedom tend to be very restricted and very high risk. So let's talk about amortization. Now, when getting a loan, it's always good to not only look at what you'll be paying now, but what you'll be paying long-term as well. So let's say, again with the car, you want to go buy a new car, right? And it's going to be a $20,000 car. You go to your bank and you say, hey, I'd like to get a $20,000 loan. Well, over the next 3 years, they will give you a loan for about 3.25% interest a month. Now, that seems a little high. You are paying roughly $580 a month. So you're like, okay, let me go to the dealership, see what I can get out of them. You go to the dealership, and they're like, okay, yeah, we can give you a deal at $303 a month, but for 6 years. And you're like, okay, so for 3 years, I can pay $580 a month, or for 6 years, I can pay $300 a month, a little over $300. Now, which deal would you take? Well, if you thinking, okay, I'm paying less per month, you'd go with the $300. Maybe not, I don't know. If you were, you would actually be paying more because you would be paying $300 a month for 6 years instead of $580 a month for 3. Now, if you were to add this all together, in the end, for the dealership, you'd be paying a little over $2,200 extra as compared to the bank where you'd be paying $1,100 extra. It's things like this where you're like, okay, am I better off in the long run by taking a taking a loan that lasts a little longer, or am I better off taking a loan that's a little shorter but I pay a little more per month? It's just good to know when it comes to debt, always look at the whole thing. Don't only look at your monthly payment, because when you think you're paying less, you could actually be paying significantly more. Now, of course, you can't forget to mention debt also can delay retirement. Now, what I mean by this is that when you have debt, right, you're not going to be putting money into your 401k or your IRA as much as you think. You're obviously going to be trying to pay off your debt. Even someone with an above average income, let's say about $100,000, they will still find themselves sandwiched in their 50s between their debt payments, kids in college, kids who are forced to come home from college because they don't have a job and can't fend for themselves, and find their total income stretched a little too thin for their liking. Now, this is why saving for your retirement is very important. And this is why I'd always urge you to always, whenever you can, pay your debt. But when you do, also just put a little bit to the side for your retirement. Right? This is your retirement. This is your life, your one and only life, you want to finish your days off nicely and with money. You don't want to pay off your debt till your time comes. So this is why I'm just saying, when it comes to debt, make sure you're paying it off well and you're taking care of your retirement, because one of the biggest factors of debt is a significantly delayed retirement, if no retirement at all. Lastly, just a couple takeaways. I want you to walk away from this knowing that debt complicates a lot of stuff. It grows a lot faster than expected. It takes a lot longer to pay off too. It adds a lot more risk into the whole thing. All this puts your future at risk. So if you're going to take on any debt, look beyond the monthly payments. Look at the total. Think about yourself in the future. Where will you be? What do you think you'll be doing? And go off with that. That being said, I hope I didn't scare you too much. This is just to put you in the loop of this is what debt is. This is what it can do to your future. And just take care of yourself. No matter what debt you take on, make sure you can manage it. The worst thing is you can't manage it and you just find yourself in a lot of trouble. That being said, I hope you walk away gaining something and not too scared. If you have any questions, please drop them down below. I am more than happy to answer them. And have a great day.